heard a lot more for stuff that's pre-80s. I heard a lot more talk about by year two, they want to be at 8% plus. And then there's a lot more appetite for even flatting or getting to what you said, like a 6-ish% cash on cash, and then hopefully 10% over the term of the entire 7-year hold on 80s, 90s, and newer.
Could you split out those two different things that you mentioned, the cash on cash and then the yield on cost?
Yeah, I'm actually looking over here at some of the notes that I've put into, of course, Excel. And I'm trying to think, let's see, we've got one East Coast group here who was specifically talking about 5%. Well, this is 5% day one, 8 to 9 by year two. Yield on cost, but fundamentally, yield on cost is typically what we talk about when we talk about any sort of heavy value add or development. There's acquisition costs, and if you buy a stabilized deal, acquisition cost is pretty much the only thing you need to consider, because you're buying an asset and then just going in to manage it. But if you're talking about putting large capital infusion into something, whether you're doing some sort of development or you are doing a heavy value add, you need to consider the cost of that capital improvement in your yield. And so you can almost think of it from very high level terms as being the acquisition cost plus whatever it's going to cost you to get to where you want to be when determining the yield. Yeah, that yield on cost, it moves in a similar way. People are looking for a similar yield on cost as cash on cash, typically.
So I know the answer to this, but why do you think that the market is pivoting from the Sun Belt or the smile of the United States into the Midwestern markets?
There's been less development and there's less supply. There are individual projects and developments, deals in those Sun Belts that are killing it.